The S&P is bullish, but a breakout is not yet confirmed. Today's July 15th, and we've been discussing how the market is in a hinge point where it's going to make a decision whether or not to be extremely bullish or to be less bullish. And we're bullish either way. However, right now, if you look at the projected dates that we've been using for the short-term swings, they've been working. We expected a high around the 15th of July. Market came up, made all-time highs today, so that's in line. It might go a little further higher the next day or two, but the key thing is the 24th of July is the next low point, where the 42-day cycle and several other of our cycles, the 261 trading day cycle and the 8-month cycle, they all kind of have a low coming in on the 24th. So if it goes a little higher, fine, but we really want to see where the low point is on the 24th. If it's a very minor correction, which it has been the case so far, that's a very bullish situation, because after that it's likely to go up into August. We're looking at highs between the 8th and 15th of August, and another high about the 22nd of August. And based on the 20-year cycle, we're also looking at the high, another high early September. Okay, so the possibility is the market could run up and continue to run up into September before a decent-sized break potentially in September, which isn't necessarily going to be a crash or anything dramatic, but enough to pull back into the range before moving higher. Our model that seems to be working the best is the 60-year cycle, and that is a kind of a gradual rally. It does fairly much agree with the 8-month cycle, which has been repeating, and with some of the other influences. It does have a pullback into middle to late September. Not a dramatic one, but it does come down, and then it goes up strongly at the end of the year. And once it finishes, this is critical because this is a very important rally. Even if the market rallies up to 8,000, which David Hunter is talking about, and we're talking about 7,600 as a potential target based upon the 1,400 point tub swing that could be repeating above the 6,200 level by the end of the year, it does not bode well for the future after that. The longer term story is we're looking for a bear market in 2026. And what's interesting is the 60-year cycle doubled. It's about 119, 120 years ago. The 1906 market has been amongst the best matches in the present last 12 months. And it agrees very closely with the 60-year cycle that we go up somewhat further. That one doesn't go up as strongly as the 60-year, but we go up somewhat further later into this late part of this year, and then we come down into a bear market in 2026. Now, it's also important to realize even that bear market is not the end of the world. Super long term, we're still bullish actually. Even after that bear market, we think it's going to go up one more time into the late part of 2028, fulfilling the 30-year cycle highs that have been coming in roughly 1998, 99, 1968, 1937, 1907. There seems to be a 30-year, slightly around the 30-year cycle that should be coming in the late part of the decade. And then after that, we could have a very, 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 very severe, multi-year, unfortunately very dramatic bear market. But right at the moment, we're still looking for bullish action, potentially a melt-up. It has not shown itself. We'd have much stronger confirmation for a melt-up if we can break above our yellow line, which we've shown before on our matrix, and this area is around 6,400. And then the market goes higher and retests that and holds. Once it holds the 6,350 area on a pullback and then rallies further, that's a good sign that we're going at least to 6,700 fairly soon. The next level above it is 7,200, and then the 7,600 eventually. We don't know when. Okay, so we need to see this break above the 6,400, retest it, and go up. We haven't broken above it even once yet. Okay, we haven't even reached it yet. So the next 10 days between now and the 24th of July is going to tell us a lot, because after that the market's likely to rally for at least a few weeks. And if this pullback into July 24th is really minor, it's a good sign that a fairly strong move will come out of it. After that, and we're in good shape. If it does not, if the pullback to the 24th is very deep, going perhaps below 6,100 or something extreme like that, then there's a good chance the 20-year cycle is the dominant path. We've seen it before. We've repeatedly shown this each week. Has a high in August, another one in September, but it doesn't really have a huge up move until after a low in early October, and then it shoots up strongly at the end of the year, and you see the big move then. Both cases are bullish. Okay, at the moment, we're strongly emphasizing the bullish scenarios. Very, very few of the bearish scenarios seem reasonable. And until we see more evidence that there is any kind of negativity coming in, we're not going to buy into that at all. In our matrix diagram here, notice the yellow line. It moves slightly higher each week. It's not very quick. It was at 63.50 a couple of weeks ago, then 63.80, and now it's closer to 63.90. But that's the way the matrix is structured, and it does show that these things have a tendency to evolve over time, but it's a very gradual thing. And it's basically the 6,400 area that has to be broken above before we're kind of free and clear to go much higher. Okay, I want to repeat, we're having our Market Forecast Mastery course start this Sunday, the 20th. It's an upgraded version of the course. I want to remind people that it is for people who are familiar with the markets, familiar with trading, and they want to get the enrichment that traditional technical analysis does not offer. This is beyond the norm. This is on the level of the secrets that W.D. Gann and Jerry Bomering, who was my mentor many years ago, that they've taught us, and we're passing it on to a very special group of students. You should remember that there are many cycles in the market at the same time. Some of them are up, some of them are down. And the basic idea here is that whenever you trade, no matter what you're doing, you need to protect your equity. You need to be in a position to assume that anything could happen at any time, and you need to have some sort of stop placement or hedging strategy in place to protect your financial future. Because it's very easy to lose a lot of money very quickly, and it's very hard to make it back very quickly. So this is an important point that we always emphasize with our students, is use a stop in every trade. And make sure that you have a very clear strategy as to what you're expecting before you put any trade on. Don't just throw money at the market. Okay. Gann always talked about using very clear reasoning, very strong logic as to why you're getting in or not getting in the market. And if you're not really clear on the thing, don't do it.